So, Mr. Minister, thank you very much for a very comprehensive picture of where Portugal is going. Let me start out by asking you to go a little deeper on a couple of the key timing issues. The markets are notoriously impatient, and more so than we economists would usually like. So talk a little more about two things. One is the return to growth. You mentioned Portugal's poor growth record over the past decade or so. You mentioned the medium-term outlook for restoring growth. But let me ask, if you can be more precise, when you think positive growth might return, and is there a level of growth, or a rate of growth, that you think might be feasible for Portugal as it returns to a positive growth picture? And then, just picking up on your last point, talk a little more about your assessment of Portugal's ability to return to private capital markets. You mentioned the key date of September 13. You might elaborate a bit on why that is so important and how you see the path from now till then, which is really the next 18 months, as your country resumes its access to the private capital markets in order to fulfill a basic objective of the overall program.
Many thanks. I've listed 3 questions instead of 2 because I would split your first on growth in 2 different aspects. The first aspect that I would comment on is when is the program assuming a business cycle upswing to take place. Now, according to the program as it stands now, according to our best evaluation, we are in a position where the Portuguese economy is contracting as we speak, and the pace of contraction is close to the strongest that is foreseen in the program. From this quarter onward, the pace of contraction will ease. During the course of this year, the quarterly growth rate will become flat, and then the program envisaged positive growth for next year already, so 2013. Now, the way the program has looked at the business cycle recovery is in complete conventional terms. That is, one does have a sharp recession which is caused by the contraction of internal demand. During that period, resources are transferred from the non-tradables goods sector to the tradables. As time goes by, the tradables goods sector starts reaching capacity constraints that will put them under pressure to expand capacity in order to be able to profit from the markets that are opening. Portuguese exports have been gaining market share throughout, so that's going to be the main driver of the recovery. But what we're talking about in this particular mechanism is the simple business cycle driven classic recovery. It's completely conventional, which is why I separated your question about potential growth. In terms of the program, that effect, as I tried to convey in my presentation, is not taken into account at all. We do not have a very good grasp of the impacts from structural reform in the short run, much less in the very short run. I believe it's fair to say that we simply do not know. Research conducted at the OECD and Eurosystem suggests that from a long-term perspective, there are very sizable effects, in the case of Portugal, in excess of 10% in the level of GDP, and according to studies of the dynamics of adjustment, more than half of that effect, about half of that effect can materialize after 3 to 5 years. Now, if that's the case, if that materializes according to that kind of scenario, what's going to happen is that structural reform is going to help the recovery of the country being strong, and will speed up the adjustment process. So that's the concept. In terms of return to bond markets, you said that markets are impatient, but fortunately, from our viewpoint, one of the benefits from the program is that market impatience does not affect the cost of financing for the country. The country is effectively sheltered from bond market yields because the yields that you see, say, in Bloomberg screens or Reuters screens are secondary market bond yields which are not paid by the Portuguese government. Therefore, they do not affect the sustainability of that path for Portugal, contrary to what some academic researchers did claim. So from that viewpoint, the program affords us time to manage this transition. In terms of how it may affect perceptions and expectations, I've tried to outline the mechanism in my presentation. What we're doing right now in terms of debt management is the following. The program only envisaged that Portugal would be issuing treasury bills at a 3-month maturity. So it was like a very residual presence in markets. What we have done already is issue treasury bills for 6 months and for 12 months. And if you look at the path of interest rates, bid to cover ratios, participation of non-resident organizations in the auctions, all those indicators have moved quite favorably since the start of the year. That is, interest rates are coming down, bid to cover ratios are going up, the share of non-resident banking organizations in our auctions have increased. We intend to continue that process, issuing treasury bills with a maturity of 18 months relatively soon. We don't have yet the very detailed blueprint of our path back to markets before September 2013, but I can guarantee that we're working very hard at it.
Okay, let me ask you to elaborate on one piece of that you've now mentioned twice, that exports have been doing very well. That seems to run counter to at least one strand of thought which says that Portugal is not very competitive, needs a big internal devaluation. Comment on it a little more. How much comfort do you take from the export expansion? How much of it is within Europe? How much of it is to more rapidly growing markets around the world more broadly? What does that say about the underlying competitiveness of the economy?
That's a complex question. Obviously, it's good news. The fact that the turnaround in the external position of Portugal is proceeding faster than envisaged in the program does suggest that the room for flexibility in the Portuguese economy is stronger. It is also clear that a relatively deep restructuring of Portuguese external trade is taking place, and that applies both when you look at the geographic composition of exports, and you do see that the share of intra-European Union at 15 has fallen significantly, and other areas of the world, including the area represented by the Portuguese speaking countries, has been expanding relatively fast, as exports to Asia, which were not important traditionally, have expanded fast. Something that you also see is that, for example, when you make categories of products on the basis of technological content, the share of low technology content products, which used to be dominant and some years ago was about 50% of our trade, has come down quite significantly, and the latest number I have available points to 37.5. And the expansion has been mostly in the medium-low and medium-high products. And if you would look at, say, specific products or categories of products, one of the things that one of my professors at university used to say is that Portugal was not a banana republic, Portugal was a pajama republic, because the exports were based on textiles. But according to my data, in 1995, textiles constituted 23% of Portuguese exports. In 2010, they constituted only 10%. So clearly, there is a relatively strong change in the composition of Portuguese exports, and some of the structural changes are surprising. For example, one of the most successful sectors in terms of Portuguese exports is footwear. In footwear, Portugal has been gaining market share and competitiveness quite substantially. Another sector that has been doing very well is paper exports, pulpwood and paper exports. But it's, if you look at the structure of Portuguese exports, it's quite diversified. Still, that doesn't mean that there is no issue of competitiveness. Clearly, there is an issue of competitiveness at this point in time. Part of the adjustment is taking place because internal demand is falling, which means that the relative price of non-tradables is adjusting. But in real time, it's very hard to know whether that's sufficient or not. And when it comes to competitiveness and the sustainability of the external position, it's very important to be cautious and not to claim success before the time.
Let me shift to a related topic, the neighborhood effects, what's going on elsewhere in Europe as it affects Portugal. You've obviously been affected by what goes on in the European economy as a whole, but also in some of the other debtor countries, particularly the program countries. So let me ask you specifically about the recent major events in Greece. The restructuring of its debt, the continuation of its program, which after much debate is now continuing, though still lots of questions raised about it. How do all those recent developments in Greece affect your situation in Portugal? What pros, what cons, what's the spillover effect to you from what's going on at the other end of the continent?
I will give you the short general answer. If you're not satisfied, we can discuss whatever details you would like to discuss. Now, first of all, the operation involving private sector involvement for Greece was a successful operation, and from the viewpoint of the participation, the voluntary participation of private sector creditors in the operation, the operation beat expectations. So the recent events were good news, and the expectation is that that will contribute quite substantially to stabilize the situation in Greece, and in accordance with the last computations performed by the IMF and partner organizations, the operation does contribute quite decisively to restoring the sustainability of the Greek debt position. From the viewpoint of my country, the aspect which I would like to stress is that the Greek PSI has always been regarded by the Eurogroup as a unique initiative. So it's something which is not to be repeated. And from that viewpoint, in Europe, it is always the case that when one is communicating about developments in the euro area and refers to developments in Greece. One typically adds that the Eurogroup regards favorably the progress that the other program countries, Ireland and Portugal, are making in fulfilling their program, and that in that context of continued compliance with the terms and conditions of the program, that the euro area stands ready to provide any additional support that may be required in order to manage a smooth return to bond market financing on the part of program countries in accordance with the program schedule.
What about the recent developments in Italy? We had Prime Minister Monti here a month ago. I think the general view is that Italy's situation is looking up in terms of its prospects for adjustment, early recovery, indeed even structural reforms. Would that, if that's correct, does that lift confidence in general in the euro in a way that will be significantly helpful to you?
Absolutely. So one of the expressions that we use in the context of macroeconomic dialogue in Europe is that economic policy is a matter of common concern. And in the context of the discussions that we have around euro area governance and changes to euro area governance that have been recently decided, that aspect of interaction is very much emphasized. From that viewpoint, success in structural reform, success in gaining credibility by a large European economy like Italy is absolutely fundamental.
Let me ask one more question and then we'll open it up. I suspect most of the remaining discussion will be on Portugal, but I don't want to miss the opportunity to ask you a broader question about how you see the evolution of the Eurozone as a whole over the medium to longer run. As I mentioned in my introduction, you've been deeply involved at the ECB in the creation of the euro itself. I could have mentioned that you represented your government during the negotiations of the Maastricht Treaty, going all the way back to the origin. So you're one of the architects of the whole Eurozone and been involved in it from the start. As you've now experienced the crisis and foresee at least the beginnings of a path out of that, what is all this going to mean for the euro, the Eurozone, the European community as a whole? Are we going to see over time movement to a fiscal union, to economic governance institutions, toward a more complete economic as well as monetary union in Europe? Where is all this going, and do the crisis events significantly accelerate the process in a positive direction, or by contrast, are they going to make it more difficult to continue the forward movement of Europe?
I'm optimistic about the prospects for Europe, and let me try to explain why. About 2 years ago, we listed a number of challenges, a number of weaknesses that had been revealed by the crisis. That was a very ambitious list, and people at technical level and politicians have been working very hard on that quite comprehensive agenda that includes fiscal discipline, macroeconomic coordination, changes in the architecture for financial regulation and supervision, also crisis management. If you look at that agenda, you see that almost all elements are now in place or have been agreed, and the only substantive decision that is remaining, if my memory serves me right, has to do with the firewall. And as you may know, the decision on the capacity of the ESM joint with the FSF is going to be discussed by the Eurogroup meeting in Copenhagen at the end of the month, which means that the architecture is then complete. Assuming, as I assume, that the new architecture is going to prove effective, then that means that the euro area will progress in a much sounder basis, because one of the weaknesses that was there from the beginning, which was its ability to prevent and manage crisis, will have been much strengthened. At a more general level, you ask whether the crisis fosters progress in European integration or hinders it. I have no doubt that it fosters it, because if you look at the number of occasions where cross-country spillovers were of crucial importance during the course of this crisis, there is no doubt whatsoever in my mind that the relevance of effective collective action at European level has become much stronger and much easier to recognize. So I look forward to see deeper and better European integration.
Good. Okay, let's open it up for questions and comments from the floor. I would ask you to go either to the standing mic in the back or speak into the traveling mic that will be brought around. Please announce yourself, your name and where you're from, and then we will put the questions to the minister. I see two hands from my colleagues. I'm at the Institute. I'm just waiting to see if there's anybody else. Three from my colleagues at the Institute. Surely someone else must have a question. So I'd prefer to go to others. So there's one in the back, and then I'll go to my colleagues. Please.
Alessandro Pio from the Asian Development Bank. I think many of the reforms we have heard are essentially supply-side reforms. But given that the recovery is still a bit fragile, especially expected for all of this year, is there scope for some support to demand? And given that the delicate fiscal situation of most of the countries affected, is there scope for some European Union intervention in supporting demand? We hear a lot about public-private partnership investment in infrastructure. Is there scope for something like a Euro growth bonds backed by the European Union and by some of the common revenues that could give some support to demand at a time when the recovery is still delicate?
Thank you very much for your question. It's a difficult question because it includes comments on supply, demand, the response, the national response at the level of Portugal, and the response at European level. So many aspects to cover. I will do my best. Starting with my country, if you look at Portugal, one of the striking aspects is that Portugal did have excess demand for a long period of time. Clearly, you could even argue that Portugal had consistently excess aggregate demand during the whole of the period that characterized the euro area, so in the last 10 years or so. The remarkable fact is that did not create growth. GDP growth was very mediocre towards throughout the period, which means that clearly growth of demand is not a sufficient condition for GDP growth, certainly not for sustainable growth. More recently, in a context which was already of a crisis, the Portuguese government decided again to expand aggregate demand, this time based on a very Keynesian argument that since the economy was shrinking, it was necessary to offset that impact and smooth the impact of the crisis on economic activity. Now that, as a matter of fact, from a very short-run perspective did work. The recession in Portugal was at that time milder than elsewhere, but I've tried to argue that it proved self-defeating from a medium-term perspective because that was precisely the trigger that led to the crisis. Now, at this point in time, when it comes to my country, if one would try to support economic activity through demand, one would have exactly that problem. We simply do not have the fiscal space or the credibility that would allow us to play that game. That, in the case of Portugal, would be counterproductive and self-defeating. One could argue whether in some other areas of Europe, one would have fiscal space to have a more active business cycle smoothing type of action. But there I find it ironic that it is typically the authorities from countries that do not have that fiscal space that claim that others do, while the ones that are supposed to have fiscal space think that either they do not have such fiscal space or that would not be wise to use it. That suggests that there is some bias in this debate, which I find intriguing. Now, when it comes to initiatives at the European level, you may know that the last European Council was a very positive European Council because it's the first, in my recent recollection, that was not devoted to crisis management, it was devoted to growth. And in that context, there are a number of initiatives that indeed will be taken at the level of each member state and at the level of the European Union in order to try to improve the prospects for growth from a medium to long-term perspective. I think it would be too long to look at some of the technical details around some of those initiatives, although some may be interesting from the viewpoint of bringing forward the process of European integration, and I believe very much in the line of what you seem to favor in your comment.
Ian?
Ian Talley, Dow Jones.
Sorry, I missed your name?
Ian Talley, Dow Jones. I'm wondering...
He's a journalist.
Yes, Dow Jones Newswires and other platforms.
So beware.
Yes, not of me. I'm wondering, Ireland, after Greece got a better loan rate, said that it should get a better rate as well. I'm wondering if Portugal desires a similar rate reduction. And you've discussed all of the merits of the program and how Portugal is succeeding. But I'm wondering where you see perhaps risks arising that would create financing gaps.
Okay. Now, interest rates are not mostly driven by desires. So what I would desire interest rates to be is something that I don't think is worth commenting on. The interest rates that I regard as crucial in this context are market interest rates, and the decisive aspect is to be able to regain access to market financing at close to normal levels well in advance of September 2013. Now, in order to do so, it seems clear to me that Portugal has to fulfill its program in a timely way, so it has to deliver the quantitative limits and the structural benchmarks of the program, and it has to do so in time in order to build the credibility and confidence that is necessary for this transition to be successful. You ask about risks, and specifically risks that may create financing gaps. I'm afraid that here I can only give you a very general answer, and I'll explain why I will only give you a very general answer. The point that one must recognize from the outset is that when you're in a crisis, the conduct of policy is risk management. So the question that you raise about risks is a key central question. It's a very legitimate question. Risks are very relevant in a situation like the one we are discussing. If we were in a situation where nothing could go wrong, it would not be a crisis. On the other hand, if we were in a situation where it would go wrong for sure, it would not be a crisis either. It would be a catastrophe. So that basically means that in a crisis, policymaking is risk management. That being said, a policymaker, and I'm a policymaker, cannot possibly discuss potential scenarios of risks in a structured way, because in terms of communication, one is never able to convey the difference between conditional statements and commitments. So one can only discuss how to tackle a specific risk once it materializes in a very specific and complete context. So one should never discuss those things ahead of time. But something which is very important is that we are not alone in this. As Fred was saying, some of the risks that we face are risks which are beyond our control, but there we benefit from the solidarity of our European partners that have repeatedly claimed that they stand ready to support the country in case it continues to fulfill its obligations under the program and faces difficulties in the management of the transition back to market financing. I hope I didn't disappoint you too much.
Now I'll turn to my colleagues. Bill Klein.
Mr. Minister, I suspect that a lot of us think the big unanswered question here is why the 10-year risk spread for Portugal is still at 1,100 basis points, more or less. Greece seems to be down to something like 550. Italy is backed off to something like 350. You can tell stories about how the downgrading took Portugal out of the portfolios of a lot of the index funds, et cetera. But it seems like there's an incredible disconnect between the sustainability graphs that show Portugal in a more favorable position than Italy and an identical position to Ireland. And I may have said Greece before I meant Ireland. Query, what is your diagnosis of why there is such a lag between the decline? Let me push a little bit further and say that maybe this complete assurance by the public sector is sort of got a downside, because it means more and more of the debt is taken over by the publics, and then at some point when the crisis does arise, the haircut on the privates is extreme. Maybe that's another way to look at this, but I'd be interested in your diagnosis. That's the first part of my question. The second part of my question, are you going to take advantage of this and start buying that debt back if you have some positive surprises on the fiscal side? Because it seems like a good opportunity to do so.
Okay, very good and relevant questions. The issue of the disconnect between fundamentals and market perception is something which is not specific to the Portuguese bond markets. As a matter of fact, I was looking in a very relaxed way to a number of books about financial markets, and I came across titles like Popular Delusions and the Madness of Crowds, Manias, Panics and Crises, Irrational Exuberance, and many others. When we were in the late 80s preparing the path to the euro area, there was a very influential paper written by Alexander Lamfalussy that made it to the final report by the Committee Delors, which was kind of like the analytical basis for the negotiations that followed, in which the committee asked itself whether one could rely solely on market discipline in order to avoid excessive deficits. And the conclusion of the committee was that no, it was not possible to rely solely on market discipline, because market discipline was too slow and weak in normal times and too sudden and disruptive under stress circumstances. So very clearly, the possibility of lasting and enduring departures from fundamentals on the part of markets and market participants is very well documented and relevant to this question. In the specific Portuguese case, it turns out that turnover in these markets is very close to zero. You have basically no trades. If you have basically no trades, you have a quoted price which is backed by basically no transactions. It's not a very representative price, and I don't think it's a price that will offer much resistance to change once there will be some dynamic, some pressure pushing it in some other direction. That leads to your second question on public debt management. And there, I'm afraid I cannot give you a very specific answer for the following reason. What we are doing is this very slow transition to longer maturities in the Treasury bill market. We are working on a concept of asset and liability management that may involve market action, but since we don't have that strategy fully worked out now, I cannot give you any specific answer to your second question. But of course, if you have specific ideas that you would like to suggest, I'm most interested in having bilateral with you.
Question up here.
Mr. Minister, I have a question on privatization.
Please identify.
George Sapari, Ambassador of Hungary. I have a question on privatization, and I would like to mention the mistakes we made in Hungary privatizing public services, and I wonder, I'm sure you are aware of it, but I wonder how you have solved it. I noticed that you are planning to privatize, or you have already privatized water distribution, gas distribution, electricity distribution. These were state monopolies in Hungary, and I presume there are state monopolies in Portugal. And what we have done is we have privatized the monopolies. In other words, we handed over the monopoly to the private sector, even though we divided the country by regions, and we gave it to different private companies, the water distribution, gas distribution, electricity company. But in that particular region, they have a monopoly. So as a result, we have the highest water, gas, and electricity prices, one of the highest in Europe, higher than in Germany, and probably higher than in Portugal. So how do you solve this problem? Have you thought about it? And if yes, how do you plan to solve it?
Thanks, Georgie, for your questions. What we have privatized up to now is only the government stake in EDP, that's the electricity producing company, and that one company is operating in a competitive market, and the degree of competition in this market is going to increase over time. The market is going to be increasing liberalized, and prices of energy are going to be determined in markets. At this point in time, the degree of integration in the Iberian energy market is already quite significant, and my own personal guess is that the degree of integration at European level is also going to increase. As you know, cross-country interconnections are going to develop gradually over time, and according to some projections, there will be a deficit of electricity in Central Europe, and in that context, it's normal to expect competition in this market to develop. EDP is by far the largest company that is covered by this process, and so for EDP, your argument applies only in a limited way. REN, on the contrary, is the network company that deals with the distribution of electricity and natural gas, so it's definitely a natural monopoly. And the issue of controlling monopoly power in the network of distribution of electricity and natural gas is something that we tackled through regulation. The reinforcement of the independence of the regulators of the various sectors is something which is in the pipeline in Portugal and is actually central to the program. Now, apart from that, what we're going to do in the area of the water companies is probably to use not a pure model of privatization, but one in which there will be a concession of the management of the water supply management to a private company, but not a privatization, which of course means that the means of controlling what's going on are stronger. Finally, the next steps in the privatization program have to do with the privatization of the airport concession and our airline, our flag airline company, TAP, and obviously TAP is very much under international competition, and the same applies to national airports. Thanks, Georgie.
John Williamson.
John Williamson at the Institute. When Bill Klein was asked to comment first, I wondered whether he was going to ask the same question as me, because it arises out of some work that he and I did together last fall. And the point is that in Portugal, the big disequilibrium isn't in the fiscal accounts, it's in the balance of payments accounts. The fiscal accounts, I think, they look pretty good. As you showed in your statistics before, the average fiscal deficit is actually above that in Portugal, the average fiscal deficit in the European community, and moreover, Portugal achieved a bigger than average reduction last year. So I think that aspect is quite good. What is more problematic is the balance of payments. And here there are two statistics that you quoted. First of all, you quoted the improved, at least you didn't give statistics, if I may say so. You mentioned that there had been a big increase in exports last year, and you said that a projection suggested that there would be no current-account deficit in 3 or 4 years' time. I'd like to know what the basis of that, first of all, what the improvement in exports last year was, how big it was, and secondly, how what is the basis for the prognostication on the balance of payments 3 or 4 years' time? I think of several alternatives. A possibility that Portuguese income is projected to grow slower than world income, a possibility that of a big gain in competitiveness, although I'd note that fiscal devaluation, that's to say a revenue-neutral change, a cut in the payroll tax financed by an increase in the value-added tax, that seems to have dropped off the agenda and wasn't mentioned by you today in the way that it was 9 months ago. Thirdly, it's possible that you just extrapolate the increase, or fourthly, it's possible that you rely on faith, as so often has happened in the past.
Okay. One step at a time. The explanation that you give, I don't remember the number, that is based on, probably it was your explanation number one, the relative growth of demand in Portugal and in the rest of the euro area, in the rest of the world, plays a very important role. As a matter of fact, if you look at the period in which Portugal was losing competitiveness, what you do see is that you can explain most of it through the positive difference between growth of domestic demand in Portugal at the time and growth of demand elsewhere. So what we have now is a process which is operating in reverse. So we're regaining competitiveness and we are rebalancing our external account through a negative differential between domestic demand and demand in the rest of the world. The point that I'm making here, which is slightly different from the way you presented it, is that I'm linking the two. When you do have this differential between growth of demand domestically and abroad, you have necessarily a adjustment in relative prices, and that is something that you get in any standard general equilibrium model. The mechanism which is probably most known here is the mechanism that you have in the paper by Obstfeld and Rogoff about the U.S. external imbalance, but the argument is completely general. You say that the fiscal situation is relatively good, the balance of payment is more problematic. I would be slightly more balanced and nuanced comparing one and the other, because this is not the first program that the country has sponsored by the IMF. It's, as a matter of fact, the third program since 1974. There was a program in 77, 78, and another in 83, 84. And in the two first IMF-sponsored programs for Portugal, the Portuguese private sector adjusted always very rapidly. And one common feature of the two programs is that the Portuguese general government didn't. We could go into the details why that is so. Now, if you look at the evidence for this particular process of adjustment, you see, first of all, that in 2008, 2009, the Portuguese private sector was adjusting extremely strongly and fast. And the reason why there was not a strong macroeconomic adjustment is because the government has chosen to offset the adjustment of the private sector. And if you look at the results for 2011, the ones that I was describing, the surprising positive results reached come from the adjustment of the private sector, not the public sector. So I would definitely not take public sector success in adjusting for granted. That's the main feature of my job description. I'm supposed to make that happen. And you must believe me that that's not easy. And when it comes to the adjustment of the private sector, the evidence that we have thus far seemed reasonably successful. You asked me about the growth of exports in 2011. They were about 7%. You asked me about the current account deficit in 2011. It was still very high at 6%, but it came down from almost 10%. So it went down from 10 to 6, thereabouts, round numbers. I'm exaggerating, but not much. But the thing is, the program envisaged an adjustment from 10 to 9. So no doubt whatsoever, the magnitude of adjustment is much stronger than envisaged in the program, and the magnitude of the adjustment is actually quite sizable. We don't envisage in the program a correction of the current account deficit in 3 or 4 years. It's more like 2 to 3 years. So indeed, at this point in time, we believe that the Portuguese private sector will again be able to adjust relatively fast.
Mr. Minister, there's a lot more questions, but unfortunately we're at our witching hour of 2 o'clock, and we try to always let people go on time. And I know you have further appointments. Thank you very much for joining us. Thank you for the progress. I was going to say thank you for the progress report. More importantly, thank you for the progress. And we'll look forward to the next installment when you have an even better story to tell. Thank you very much. Thanks to all.